Ever wondered why the stock market suddenly takes a nosedive or skyrockets for no apparent reason? It's not random magic. A lot of the time, it's the economy talking, and if you learn to listen, you can become a much smarter investor. We're talking about those big economic indicators things like GDP, inflation, and unemployment numbers. Today, we're going to demystify these reports and show you exactly how they influence your portfolio and shape the entire market landscape. By the end of this video, you'll be able to read the economic tea leaves like a pro. So, let's get right into the heavy hitters. The first one everyone talks about is the gross domestic product, or GDP. Think of GDP as the country's total report card. It measures the value of all goods and services produced over a specific time. When GDP is growing, it means the economy is expanding, businesses are making more money, and consumers are spending. This is generally fantastic news for stocks. Strong GDP growth usually leads to higher corporate earnings, which in turn pushes stock prices up. Investors see a healthy economy and feel confident putting their money into the market. On the other hand, if GDP growth slows down, or even worse, turns negative, that signals a recession. In that scenario, corporate profits shrink, and investors tend to sell off stocks, causing market downturns. Remember the sharp recovery we saw after the initial 2020 dip? That was largely fueled by expectations of a strong GDP rebound as the economy reopened. Next up, let's talk about something that affects every single one of us: inflation. The main way we measure this is through the Consumer Price Index, or CPI. The CPI tracks the average change in prices paid by consumers for a basket of goods and services. When inflation is low and stable, around the 2% target for most central banks, it's usually seen as healthy. But when it starts to climb too high, it's a major red flag for the stock market. High inflation erodes the value of money and can eat into corporate profits because their costs for materials and labor go up. To combat this, central banks like the Federal Reserve step in and raise interest rates. And that brings us to the next crucial point: interest rates. When the Fed raises rates, it becomes more expensive for companies and consumers to borrow money. For businesses, this means less investment in growth and expansion. For consumers, it means higher mortgage rates and credit card payments, leading to less discretionary spending. This double whammy can really slow down the economy. Certain sectors are particularly sensitive to rate hikes. Tech stocks and other high-growth companies, for instance, often rely on cheap borrowing to fuel their expansion. Their future earnings are also worth less in today's dollars when interest rates are high, which makes their stock prices fall. We saw this play out dramatically from late 2022 into 2023, as the Fed's aggressive rate hikes sent the Nasdaq, which is heavy on tech stocks, into a bear market. Conversely, when the economy is weak, the Fed might cut interest rates to encourage borrowing and spending, which can give the stock market a significant boost. Now, let's shift gears to the job market. Every month, the jobs report, officially the Employment Situation Summary, is one of the most eagerly awaited economic releases. It gives us two key numbers: how many jobs were created and the unemployment rate. A strong jobs report with high job growth and low unemployment is a sign of a robust economy. More people working means more people spending, which is great for corporate revenues. This typically sends the stock market higher. However, there's a catch. If the job market gets too hot and wages start to increase rapidly, it can fuel inflation. This might force the Fed's hand to raise interest rates, which, as we just discussed, can be bad for stocks. It's a delicate balancing act. A Goldilocks scenario where the job market is healthy but not so hot that it sparks high inflation is what investors really love to see. Looking at recent years, periods of strong job growth have often coincided with bull runs in the market. But the fear of an overheating economy is always lurking in the background. Another indicator that's become increasingly important is the Purchasing Managers' Index, or PMI. This is a survey of purchasing managers at hundreds of companies. It's a fantastic forward-looking indicator of economic health. A reading above 50 indicates that the manufacturing or services sector is expanding, while a reading below 50 signals a contraction. Because it's released monthly and provides a quick snapshot of business activity, investors watch it closely. If the PMI comes in unexpectedly strong, it can boost market confidence. If it shows a sudden drop, it can trigger fears of an economic slowdown, leading to a set. For example, a weak PMI report from a major economy like China can have ripple effects across global markets, as it suggests lower demand for raw materials and finished goods worldwide. Finally, we can't forget about consumer confidence. This is more of a psychological indicator, but it's incredibly powerful. It measures how optimistic or pessimistic consumers are about their financial situation and the overall economy. When confidence is high, people are more likely to make big purchases like cars, homes, and vacations. This spending drives economic growth and boosts corporate profits. When confidence is low, consumers tend to save more and spend less, which can slow the economy down. Reports like the University of Michigan Consumer Sentiment Index can move markets because they provide a glimpse into future spending patterns. A surprisingly high confidence reading can give stocks a lift, while a plunge in sentiment can do the opposite. Throughout 2023 and 2024, we've seen how consumer sentiment has been swayed by inflation and interest rate concerns, and the stock market has often reacted in lockstep with these shifts in mood. Let's look at a concrete example from the 2023 to 2025 timeframe. In early 2023, inflation was still a major concern. The CPI reports were coming in hot, and the Fed continued its series of aggressive interest rate hikes. As a result, growth-oriented sectors, especially technology, struggled. Companies that weren't yet profitable or had high valuations based on future earnings were hit the hardest. However, as we moved through the year and into 2024, we started to see signs that inflation was cooling. The CPI numbers began to trend downward. This led to a shift in market sentiment. Investors began to anticipate that the Fed would soon stop raising rates and might even start cutting them in the near future. This expectation fueled a major rally, particularly in the same tech stocks that had been beaten down. The market started pricing in a soft landing, a scenario where the Fed tames inflation without causing a major recession. Any economic data point, whether it was a jobs report or a GDP reading that supported this narrative, was met with a positive market reaction. This period is a perfect illustration of how markets are forward-looking. They don't just react to what's happening now. They react to what they think will happen next, based on the clues provided by these economic indicators. Looking ahead towards 2025, investors will be closely watching to see if inflation stays down and if economic growth remains resilient. Any deviation from the expected path will surely cause volatility. So, to recap, the economy and the stock market are deeply intertwined. Strong GDP growth and healthy consumer spending create a positive environment for stocks. But high inflation can force central banks to raise interest rates, which makes borrowing more expensive and can hurt corporate profits, especially in growth sectors. The jobs report gives us a vital sign of economic health, but a market that's too hot can also spook investors. And finally, sentiment indicators like the PMI and consumer confidence give us a forward-looking glimpse into where the economy might be headed. As an investor, you don't need to be an economist, but understanding how these key indicators work together gives you a massive advantage. It helps you understand the why behind market movements and make more informed decisions about your own portfolio. It's about connecting the dots between the headlines and your investments. Thank you so much for watching. I hope this breakdown helps you navigate the market with more confidence. If you found this video helpful, please hit that like button and subscribe to the channel for more deep dives into the world of investing. Let me know in the comments which economic indicator you find most useful. Stay smart, stay informed, and I'll see you in the next video.